As you are aware that the Gulf states are all facing critical junctures in their own light, where their policies today will predict economic stability to come. Whether it is Saudi Arabia with a youth unemployment rate of over 20%, or Qatar facing an economic blockade and forced to recalibrate and innovate with regards to its economy, or Bahrain undergoing a transition from having oil revenues and facing fiscal challenges, or Kuwait finding reforms or trying to implement reforms and trying to get buy-in from different sectors of society. All are undergoing substantial transformations that create both winners and losers. However, as always, such shifts emerge with new investment opportunities. The Gulf states have spearheaded new initiatives and reform, whether it be from economic reform, immigration reform, or labor reforms, or they've also tried to attempt to establish an entrepreneurial environment by creating innovation ecosystems, or the classic economic practices of issuing large bonds or increasing IPO issuances. And as we know that generally the Gulf states are famous for their mega infrastructure projects, which are always common investment opportunities within those states. In light of these new opportunity and challenges, key questions arise. How can investors navigate these investment opportunities in a complex geopolitical environment? I mean, as we see today, there's some movement with oil tankers, and obviously that would probably have some implications on the oil markets, but there's also this China trade issue with Trump, so that kind of negates the price changes. So, I mean, obviously whatever's going on in the region affects those economies and are very important to watch. What are the risks that inhibit these investments, and how can they be overcome? And what are some emerging opportunities for investors in the Gulf states still developing non-oil sector? Rachel?
Sure. Thanks to you, Dania, and the Gulf International Forum. It's a pleasure to be here to talk about this broad topic. I want to situate a bit of this sort of question mark about investing in the Gulf in a broader global context, and to talk both about how. Can you guys hear me at the back? Okay. If not, feel free to wave at me, or, I want to put what is going on in the broader context of a shift in the role that the GCC is playing in global capital markets development, particularly on the debt side, which has dominated the capital inflows into the region. As many of you know, tracking the region, the Gulf has long been, particularly over the last couple of decades, has been a net contributor of capital to global markets. The big sovereign wealth funds of the region, particularly of Abu Dhabi, of Kuwait, of Qatar, and Saudi Arabia, have been major purchasers of global assets. And those still are managing funds equivalent to about $2 trillion, especially when one calculates in the role of local central banks as well. What's changed in the last few years, as Dr. Merza highlighted, and I'm sure the rest of the panel and all of you have been to many, I'm sure, economic diversification discussions about the region, so I don't need to belabor some of that. But what's changed is as both oil prices have fallen, but also domestic spending needs have increased dramatically, you have countries in the region really looking for capital. And at a time when many other emerging and frontier markets have been wary of tapping parts of the capital structure, you've had a dynamic in the last 2 years where actually Gulf countries dominated capital market issuance in US dollar denominated assets. So I want to talk in the couple minutes remaining to me today about some of the positives and negatives of that dynamic. And I'm sure we will get into a little bit of debate as this goes on, particularly with my friend Karen, who we often, whether on Twitter or otherwise. But I want to make sure to put in broader context. If we look at 2018 and 2017, each year between Saudi Arabia, Bahrain, Qatar, and Oman, over $20 billion were issued in hard currency, in US dollar denominated debt. Another 15 billion or so was issued in local currency debt. These are pegged to US dollar. But what's shifted, and to put that in context, there was only about $100 billion in US dollar denominated new debt issued across the emerging and frontier world in 2018. So that means the Gulf accounted for about 20%. And if you add in Egypt, you are looking at definitely a plurality in the region. And so that's very much a sea change. As I said, one of the drivers is both that the Gulf is issuing more, but the other driver is that many other emerging markets were avoiding issuing in US dollars. They could issue locally. As we go into 2019, it's been a tougher capital markets year for many emerging markets. It's also had moments of being a very good capital markets year for many frontier markets who've jumped and issued. So we've had countries like Uzbekistan and a wide range of other frontier markets take advantage in issuing US dollars. So if I look ahead at the forecasts, the Gulf countries will probably issue as much sovereign debt and government-related debt, but their share in the total global pie might be a little smaller. Regardless of where this ends up, this is still sort of a sea change in terms of both what this means for emerging market investors. They have to pay attention in a different way to the fiscal positions of the Gulf. But I think it's also relevant and marks a sea change for local policymakers. Historically, if we go back 5 or 6 years ago, when a country like Qatar or even Saudi Arabia would think about issuing sovereign debt, and in Saudi Arabia's case, they wouldn't, when they thought about it, the goals for Abu Dhabi or for Qatar were almost altruistic. There was a goal of the sovereign will issue debt so that government-owned entities or the private sector can issue off of that benchmark. So it would be trying to drive capital. Now they're doing it not only to try to develop a more liquid market, but also because there is a choice locally of either of turning to capital markets to make up fiscal debt and deficit. And that's where, and we can spend time talking about this later, you do have very different balance sheets throughout the region. I'm sure many of you are aware of the fiscal vulnerabilities in Bahrain and Oman versus other countries, and the dynamic. The big game changer from a capital markets dynamic, both on the debt side and over time potentially on the equity side, has been Saudi Arabia. Saudi Arabia, a country that in past oil busts has preferred to borrow domestically from the banks, but is now very much turning to international capital markets. That, I think, is important in and of itself because of the speed of increase in the increase in debt levels. And I'm not worried about whether Saudi Arabia can refinance and pay for the debt they have today, but the rate of increase every year does raise some concerns. It also suggests to me that it reinforces a heavy government driver of economic growth and activity, because some of the government debt issuance, rather than opening up capital markets for the private sector, is arguably crowding that out. And that's something that we might come back to in the Q&A. And we can come back to whether or not that's a bad thing or not. Economists tend to think it's a bad thing, but I think it always, whenever we're talking about debt and other spending dynamics, a lot depends on where's the money going to, what's the accountability. And then the other dynamic that I think is quite important is raising a question mark about the other thing that's quite important is the way in which debt inflows have really dominated other sources of capital. A lot of the sort of conferences that Dr. Merza has talked about in every country in the Gulf and many other emerging markets have events like this. A lot of them have included roadshows on equity, on debt. What has been striking has been that most of the capital inflows into the region have been on the debt side, partly because investors may look at it and say, yes, fiscal deficits fiscal positions aren't as strong as they were a few years ago, but we're not worried about repayment terms, with perhaps the exceptions of the couple of countries I mentioned. That what is striking, though, is that the capital inflows onto the equity side and even the longer-term investment, a foreign direct investment, have been much smaller. I spent the morning at the Emerging Market Private Equity Association event and was looking at some of their data, and they highlighted that there had been an increase in direct foreign of private equity flows into the Gulf and the Middle East region in 2018 from a low in 2016 and 2017. But that increase was projects equivalent to about $500 million. Now, I've just said $500 million in contrast to $20 billion in debt financing. So, again, not to say there are several reasons why that might be the case, including ongoing governance and principal agent challenges like the wind down of the Ebrahim Capital whole mess. Mess sometimes seems to understate it. Again, something we can talk about. But I do think there are important questions that come up when there is a reliance on debt capital, which is one of the dynamics that investors may be able to do that. I'm going to end here, but just to say that happy to come back in the Q&A in terms of thinking about the impact of these Gulf markets moving into global indices, which I do think is probably fairly priced in to those assets at this point. We look at past examples, including even in the region, and the big benefit of capital flows tend to come before they formally enter the index.
Okay, great. Thank you, Dania, and thank you all for being patient. This is trying all of our skills today and patience. So I thought I would focus my remarks on thinking about the future of the Gulf economies with a look at Saudi Arabia. And trying to look forward, really 10 or 20 years. I mean, there's a lot of expectation, of course, around the Vision 2030 objectives in Saudi Arabia, but even if we look a bit further to 2050, and why this time period, why this next 10, 20 years is so important for this part of the world. And will these countries be more integrated, more productive, more or less diversified? These are very much open questions. I think there are three major shifts that are underway, which deserve some attention. The first is a continuation on energy-dependent growth. Notice I don't say oil-dependent, right? So energy-dependent in its full scale of production and possibility. The second is on debt reliance, which Rachel just gave us a really nice overview of, and I'll just mention a few more things about that. And the third is what I see as regional economic statecraft and really the rise of financial intervention of the Gulf states to a much larger sphere of influence. So that's within the MENA region, to the Horn of Africa, to West Asia. And why does that matter? Because I see it as a real displacement of traditional mechanisms of development finance, and it will change the way the governments make choices about development and defining what development means and how its institutionalization moves forward. So let me focus on those three things, and first with the future of energy-dependent growth. So diversification in all of its glory has still pretty much come down to this. All of the Gulf states are still reliant on oil and gas. That's not changing. And the way that these states define diversification now is very much energy-centric, but seeing this from upstream to downstream to the production of all kinds of products, petrochemical products in particular. So that is the future, and that is what diversification really means. it also means a shift in realization of the consumer base. So this is very much an eastward turn, as I wrote in a paper for AEI in February, the Gulf's eastward turn. So the target market is Asia, China and India specifically, where most analysts expect to see the largest increase in middle income or middle class consumer growth going forward. So again, looking to 2030 to 2050, this is where the growth in the global economy will be. Those are the people who will be buying more things, especially cars and plastics, and driving our global economy. So by 2030, emerging market world GDP share will be rising, while we'll see a share of world GDP, if we look at by region, emerging markets take up a bigger bulk, whereas we see growth in the United States and Western Europe really flat, right? And this is just a product of demographics and really a wonderful development story of the rise of middle-income consumers. India is set to be the world's fastest growing area for energy consumption at 3.1% annually to 2040, and that's according to BP's estimates. So 2030 up to 2050, I think, is a really benchmark time because the declining energy demand from the rest of the world is based on a lot of reasons, right? One is we're getting better at being efficient, right? We should all be very happy about this, right? The electrical vehicle story is important, but it's not the only story. We're getting better also about consumer preferences in the way that we use plastics, right? So not everybody wants a plastic straw anymore. That's happening in the US and Europe, but pretty soon that will be true also in China and India. So we're looking at basically an upward curve and then flat declining. Here's a good example. If you think about cars, so Barclays estimates that by 2050, we will need 22 million barrels a day of oil for car activity around the world, running cars. How much do we use now? 20 million. So only an increase of 2 million barrels of oil per day. And how many more cars will be on the road in China and India? We're going to double, more than double the amount of cars in the world to 2.3 billion cars. Right now we have about 1 billion. But the demand for the oil to make those cars run is only going to increase by about 2 million barrels a day. Why? Because cars are getting more efficient. We have better technology, right? And not just about electrical vehicles, but fuel engines. So that's what's going on in the story, and that's what Gulf economies see very clearly. They see their market as east. They know they have to be more competitive, and that eventually 2030, 2050, the demand for their key export is flat or declining. There's also a story about targeting their own investment vehicles, and Rachel also mentioned, this massive allocation of Gulf investment through sovereign wealth funds abroad. And it's not just sovereign wealth fund, but also foreign direct investment in there, near abroad. So if we look at the countries that have the capacity to double their size within 10 years, this is what some economists call the 7% growth club. If you can grow 7% a year for 10 years, you'll double the size of your economy. And if we look forward to 2030, what kind of countries will be able to achieve that kind of growth? Well, it's very interesting. China has been doing that for a while, but is slowing. India will be important. Ethiopia will be important. The Philippines, Vietnam, Cote d'Ivoire, right? And these are the kinds of countries where Gulf states and their investment vehicles are engaged, politically, economically, strategically, right? So the move to the Horn of Africa for military strategic security reasons also has an economic component, and that's why. Renewable energy has become a good diversification strategy in terms of basically the priority of monetizing the asset you have. So turning the oil you have in the ground into something you can export now or turn into petrochemical products and sell eastward. So why are we seeing investment in solar, also in nuclear across the Middle East, but particularly in the Gulf? That's why, right? There's no point in having dirty oil-consuming power plants. It also saves water, and that's a real issue for the Gulf states. If we think about the impact of climate change in this region, what will be very difficult in terms of being able to inhabit this region, but also the scarcity of natural resources, of water resources. The shale revolution is not just something that happened in the U.S. This is also important in terms of technology and investment in energy and diversified energy production in the Gulf states. We're seeing a real investment in Oman. They're using soil generated steam for heavy oil production, pioneering the extraction of gas from tight reserves. This is really interesting work that's going on in Oman now, new discoveries. In Bahrain, the same new discovery, unconventional oil and gas discovery. And Aramco plans to produce its domestic supply of shale gas, doubling its gas output over the next 10 years. So when I say energy diversification, energy as a focus of economic investment and economic output for the region, it's not just about oil, right? It's everything from upstream to downstream to unconventional and technology-heavy and investment-heavy extraction. They've got new investment partners too. So the national oil companies of the Gulf states are more and more engaged in partnerships they have in the past with different kinds of partners. So the big oil firms are still there, but instead of the Exxons and the BPs of the world, who is winning new joint venture agreements with ADNOC and Aramco? They're Chinese firms, which is very interesting. So we're seeing NOCs partnering with other NOCs. And this again consolidates that alignment eastward that we see happening in the Gulf now. ADNOC has made recent concessions to several new Asian firms, Indian, South Korean, and Chinese state oil companies, which is very, very interesting. In the nuclear power sector, there are 20 current or planned plants underway in the Middle East. That's a massive expansion of nuclear energy production in a very volatile region. That should make all of us maybe a little nervous. The debt reliance, the second point, which I think Rachel covered really nicely, there has been this massive expansion of sovereign issuance, especially from oil exporters, but from oil importers as well. And so I wrote a piece for Al Monitor recently about the coming MENA debt burden. I do see this as a problem, especially for oil importers, but oil exporters too. And this just means that your fiscal burden and the kind of choices that you make with, how much money do you have and how much money will have to be devoted to debt repayment 20, 30 years down the line for a country like Oman or a country like Bahrain really becomes a burden on what you can't spend on defense or education or healthcare. The third point was more on this, what I see as an expansion of economic statecraft and financial intervention in the region. But let me go back. I want to make another point about debt, actually. Rachel mentioned, if you look at GCC sovereign debt issuance, now it makes up about 30% of all emerging market sovereign issuance. So that means it's not just a Gulf problem, it's an everybody problem, right? Because if you're an investor in emerging market debt, and you probably are in one of your retirement plans and you don't know it, this is something that we all carry. And it also means a burden for international financial institutions as well. And not just about, the debt that you carry, but what you do with it, the choices that you make about how to spend it. And we might also disagree a little bit on how sustainable the Saudi issuance is. So if you look at Saudi's debt to GDP ratios just 4 years ago, or in 2014, 2015, was about 10%. Now it's approaching 30. And so 30 in itself is not dangerous, right? A country like Lebanon, it's like over 100%, or, Egypt, it's mounting quickly. But the slowdown is not happening, right? This is a pattern that is now persistent. And the reason is the burn rate is high. Saudi Arabia continues to have expansionist fiscal budgets, even through declining oil prices. Thank God this year oil prices are a bit higher. The budget for 2019 is based on an expectation of about $77 per barrel oil, Brent oil. And we're probably going to get that, not because there's a lack of supply of oil in the world, but because political reasons are driving the price higher. The problem is, if Saudi Arabia continues to spend the way that it does now, and the reason why it continues to spend is a demographic issue, right? That the population has grown, and people have an expectation of what the state should provide, as all of Gulf citizens do upon their governments. Projections are at current spending levels and without access to debt issuance. So Rachel is right. They have the access. There's plenty of investors perfectly willing to buy this debt. But if they didn't have it, for whatever reason, Saudi Arabia would have just about 7 years of wealth stored away to cover its current and projected recurring fiscal deficit needs. And this is not my number. That's an HSBC estimate. Whereas if you look at Qatar and the UAE, they could go on spending the way that they're spending without access to international capital markets or domestic capital markets for 75 or 85 years, right? So just to put it in perspective, how tight that time period and that burn rate becomes. If you've been following the projection of support, of direct financial support to the region from the Gulf states recently, it is really overwhelming. And it's within the Gulf as well. Of course, the support promised to Bahrain, the $10 billion this year, is an important one, which needs to be forthcoming. But about $16 billion to Pakistan, $3 billion to Ethiopia, $3 billion to Sudan. Over the course of since 2013, almost $20 billion to Egypt from Saudi Arabia, Kuwait, UAE combined. What does this mean? It means that the region, and the region I'm speaking very broadly as a sphere of influence, is becoming more and more dependent on the Gulf states to meet their own, just running government needs, right? Without a whole lot of what we used to call conditionality, what the World Bank or the IMF would lend is advice on governance, advice on how to spend the money and how to grow an economy, development. These packages don't come with the same strings, right? They don't really come with many strings at all. So what does that mean for governments that are struggling for stability, a government like Sudan, a government like Ethiopia, really looking to plan ahead with tremendous growth opportunity? As I said, Ethiopia is one of the few countries in the world that has the capacity to grow at 7% for 10 years, double the size of its economy. But that doesn't happen magically. It happens with institutions, right? And if you're getting capital inflows from the outside and not that same, okay, here are some rules or ideas or guidance about how to spend that money, then it will be wasted.
Not gonna go well.
Yes.
Oh, good. He's back.
Yes. Let me start from the beginning about the Kuwait economy. As you know, we depend on oil. Almost 90% of all revenue depends on oil. This has almost more than 50, 60 years in Kuwait. For the last 10 years, we've been focusing on diversifying the portfolios of revenues, and we start focusing on the industrial sector. Since 2013, we focused more on three sectors. The first one, the telecommunications. Number two, we focused on the industrial, such as health sector, education, and infrastructures, like railroads. And if you come to Kuwait right now, we see there's a huge infrastructures in Kuwait. The investment in Kuwait has been growth. I'm talking about the foreign investment in Kuwait. Since 2013, it was less than 3.5 billion. Today it's 7.6 billion. That's only Kuwaiti KD. So you multiply this by 3.3, it's almost $21 billion. Only in 2017. In 2018, it's reached 8.2 billion KD, which is almost $24 billion. Kuwait today, they're focusing more not on oil, to be honest with you. They want to bring more foreign investors, different sectors from different countries. And last November 2018, we had a big conference in Silicon Valley, San Francisco, called Kuwait Investment Outreach Roadshow. That's to discover the opportunities in transformed economy. And it was at a big conference in Silicon Valley last November. And in fact, we got so many people who are interested to invest in Kuwait. Politically, we are very stable. As you know, Kuwait is the only country in the GCC that's had a free of speech, media. It's not like other countries, to be honest with you. That's number one, which is very important. For the foreign investors who come to Kuwait now, today they are free to open their license, to get also a free land, industrial land. Last month, the Minister of Trade in Kuwait, he gave the approval of distributing 1,200 lands, industrial lands in Kuwait. That's for free. And as you know, Kuwait, there's no taxes. The inflation rate in Kuwait is very stable. Employment rate is very low. The economy, is growing substantially, not very high, but stable growth. And we are attracting, for the next 5 to 6 years, more people to come and join Kuwait, for investment, for healthcare, for education. As you know, we have different, if I want to look at the education, we have American University of Middle East. 7 years ago, they had only 1,000 students. Today they have 11,000 students. That's in 5-6 years. American University of Kuwait, they have more than 3,000 students. And in addition, the Kuwaiti government, they give free scholarship for the students to study in Kuwait. We have a free healthcare. That is for people who are paid. That's why we have many hospitals. They keep opening new hospitals, the new clinics, and seriously, the doctors are now becoming a millionaire for the last years. So if you are a dentist, I think if you come to Kuwait and in 3-5 years, you at least will make $3-5 million. So I really encourage you. For us as economists, we just give analysis, we just teach people, and by the end of the day, we get our salary, nothing else. I really don't know where should I focus, but in terms of the countries who are spending or let's say focus their investment in Kuwait, Canada, US, France, Spain, and China. China, now they have an agreement with Kuwait government again to invest billions of dollars in infrastructures, especially in telecommunication and industrial and banks as well.
Will the security stability in Iraq affect the attractiveness of investments? I'm not sure if you follow Iraq, but she generally follows many of the economies in the region. And she also follows the broader Middle East, especially with her capacity at AEI. And how will a stable Iraq affect the economies in the Gulf?
Great. Well, thank you. Thank you for the question. I saw some good news on Twitter today. My friend Lawai Khatib, who's the electricity minister in Iraq, has announced that they've increased electricity capacity. There have been some really favorable new investments into the sector. So I see that as incredibly promising. All right. So yeah, positive story. The rapprochement or the renewed interest of the Gulf state or the GCC states into engaging more directly with Iraq seems to be on the horizon, though I don't think the numbers are anywhere what Iraq would like to see or what actually, frankly, the investor community would like to see. But it seems to be moving in a positive direction. So yes, they're absolutely always connected, and instability in one region pours over into the other, and we've all been dealing with this, the integration of the region forever. And when we see the continuation of conflicts and unresolved conflicts, from the Palestinian issue to Syria to now Yemen to what's coming up in Libya, I mean, all of these things hurt everyone, right? Particularly those of that are in shared industry, the oil markets. So, yeah.
Okay, I would also like to add a point to that, is that the Gulf economies also benefit to a certain extent of some instability, especially with regards to the oil markets, because it creates more demand for oil and the prices go up. So I think that is one factor that I guess a stable Iraq would be less stable for the Gulf, but now we have Iran sanctioned, so that's just an additional perspective. But of course, instability in the neighborhood is generally not good for your neighbors. So this is, again, for Dr. Young, and if you, Rachel, you find any perspectives on this issue as well. Are Gulf plans for downstream diversification into petrochemicals, et cetera, realistic? Investors have expressed much less interest in these projects than the Gulf state governments.
I don't know if that's true. Who asked that question?
Oh, no? Yes. Nate Mason, CNO, with CNO Resources.
Okay. Are they real? Yeah, they're definitely real. I mean, it's a huge focus, and this is a strategy of survival in many ways. What's interesting is that we're seeing maybe some kind of forced partnerships or joint ventures between national oil companies, which is interesting. So you get less disclosures or less information about some of these projects. So, for example, ADNOC has some ventures in Pakistan. Would other investors be as interested in those? Probably not. Yeah, so that's fair. But the general petrochemical story, as far as it is geared towards consumers in India and China, I think is an absolutely valid one. And
I mean, petrochemicals in the Gulf, not the...
Oh, production domestically.
Production in the Gulf. Not so interesting, in my experience.
What's your view?
I mean, my view is that they're realistic. The question mark always comes down to price and other, sort of other dynamics there. I think you look at some of you obviously have the existing plans most developed in Saudi Arabia, but also some of the stories in Abu Dhabi, which have been sizable. I would do maybe a little bit of a grain of salt in terms of what are the scale of ramp up, but I do think they're quite serious about that. But the question mark comes down to, we continue to be in a world where with not only the U.S., but also the Europeans looking to look at subsidies from state-owned enterprises with a finer tooth comb. I mean, that's one of the things. There are many, many problems with the EU GCC trade agreements. So this is not the only issue, but petrochemicals and state support or not have definitely been an obstacle there. So I'm mentioning that as not that Europe would be a growth market, but the sort of trade, the price dynamics are challenging even looking out. So I think they're serious. The question mark is also what sort of role do they see for foreign partners and local partners? And that's not necessarily clear to me yet, but petrochemicals are not an area I'm specifically an expert in. I don't know if that matches with you.
Okay, another question relates to security in the region, and how do you think the increasing level of maybe conflict with Iran would affect these economies? I know this is a very geopolitical one, but it's Washington, and
there are economic elements of it. I mean, there's one level where increasing concerns about conflict insofar as they question security of energy supply and force even more need to come up with alternate supply chains and ways of getting the energy out that potentially add to sort of upward moves in prices. And that, as we've said, in and of itself is positive for Gulf economies and for their balances. The reason why that's happening is not necessarily positive. Then I think the question mark is how much of this is threat versus actual limitations on not just energy supply sort of getting to market, but other goods. Karen's highlighted that both in energy but also in other goods, the importance of particularly both consumers and producers in Asia for countries in the Gulf. I mean, if we think about Dubai, for example, which historically had a lot of links with Iran, those have been diminishing in part because of Dubai and Abu Dhabi dynamics, in part because of U.S. enforcement of sanctions, a whole range of issues. It is a country where exports and re-exports and logistics are a major driver of growth, and And so you have these sort of structural challenges and greater competition in the region that have nothing to do with the escalation of political risk, which could be exacerbated in that way. The other broader question that probably Karen may be more able to speak to than I is, to what extent does ratcheting up lead to even more military spending and other dynamics, which, as we know, are major parts of government spending already at this point.
Yeah, I would add to that. I mean, this question of choke points, right? That's bad for everyone. So in the Bab el-Mandeb or the Strait of Hormuz, it's not just about the delivery of oil and gas products. It's about fertilizers, wheat, rice, right? So all kinds of commodities which will affect the global economy if these choke points are in danger. So what the news cycle today is responding to this drone attack on the Saudi pipeline. I mean, there's been some benefit. We don't have a shortage of supply of oil in the world, right? What we have are some major producers of oil who have political conditions which don't allow them to export. So Venezuela, Libya, Iran, because of sanctions. And so the producers who have benefited from that, of course, have been Saudi Arabia and Russia to a great degree. But if your ability to export comes into question, like what has happened today, that doesn't do you any good if things go up in the, prices go up in the 70s or even to the 80s or 90s. So that's a very, very big problem. So I would say, yes, what are we looking out for? We're looking out for commodity flow, not just oil flow, in all of these kind of choke points from Suez to the Bab el-Mandeb to the Strait of Hormuz. We're looking for the control of, off-book operations of proxy, actors. If this was a Houthi action, and that creates a lot of problems politically here in Washington. How do you pinpoint responsibility for that kind of attack? And it would take a lot of time and intelligence work to really be able to make the case of a direct connection to Iran, if there is one. And so that puts us in a position where I think the world is familiar. We've been there before. It's very reminiscent of 2003, or 2001, 2002, and 2003.
Okay, so let's shift gear to the private sectors and discussing the private sector development of the rentier Gulf economies with regards to the growing youth or the youth bulges that exist there. I mean, as we can see in Saudi Arabia, we have youth more eminently entering into the private sector. How successful have these private sectors developed in developing in the non-oil sectors for the growing youth? I mean, obviously, and you cannot continue to absorb all of the youth into the public sector, which is oversaturated in many of these countries. If you could just shed some light.
Yeah, I mean, there's no easy answer, right? No government is good at this. Right? No governments are very good at creating private sector jobs, and why would they be? It's private sector, right? So how do you create the conditions for growth? It doesn't happen in 2 years. It's really hard. Saudi Arabia, unemployment numbers are not really improving. They are improving for women, and that's exciting. And there are some bright spots and some kind of ripple effects of women's economic mobility, which I think are incredibly promising. I just wrote a piece. I shouldn't say it here because someone will steal my idea. No, there's some really bright spots, particularly in access to mortgage finance for women in Saudi Arabia. So, I mean, there's a new paper by my friend Elena Yanchovicina at the World Bank, it's a great paper, and she's writing about how do you direct policy that has a gender focus, right? Has a goal of creating and amplifying women's economic opportunity, but also has good overall development effects, creates economic growth for everybody. And as, policymakers, this is hard work. It doesn't always turn out that way. You can have a very good, ambitious plan that's great for women, but really doesn't help the overall economy. So what are the kinds of policies that do? And so I think, for one, the expansion of mortgage financial resources, basically the expansion of bank loans, is going to be great for women, and it's going to have really interesting effects in Saudi society. So that's a bright spot.
If I can add, so I think more generally, whether it's mortgages or just generally credit access is important, because credit access has been a problem in the region and in other countries as well. Sort of thinking about what's the information, what's the kind of collateral that's accepted. So I think that's quite important, both on general lines, but also others who are sort of particularly in countries like Saudi Arabia that are kind of below line of, sort of precarious, maybe not below the poverty line, but at a precarious level. So that access to credit, whether it's SMEs, whether it's mortgages, that's an important question, like getting the banks to trust different forms of collateral. Historically, and I want to pick up on something Karen said at the outset, which is that over many years, this will probably still be energy-driven growth. One of the other elements that maybe that I would highlight there is that the energy revenues continue to directly via government spending, but also indirectly via liquidity through the banking system to support the private sector. And so, again, that means there's a greater correlation to energy markets and revenues, but it's been easier to create sources of demand than it has been necessarily to employ young workers. Now, one challenge is what's the reserve cost that workers have to go into the market. These are still countries that tend to have fairly high public sector wages that the private sector often has to match, and that can be challenging, particularly if there's a learning and training process. So I think some of it is also funding going into partnerships with industry on the sort of skills that they're looking for. Temporary, sort of short-term contracts, things, sort of things like that are part of the picture. As I think Karen has written a lot about, even though there have been declines in migrant workers and foreign workers, there hasn't necessarily been a compensatory massive increase in employment rates of Saudi nationals and other nationals. And that's something I think to watch.
Give these ladies and the gentleman a round of applause for their insights.
Yeah, thank you.